Welcome into Retire Smart Maryland YouTube. I'm Prashant Sabapathi. This is my business partner and friend, Nick Innerbichler. Thanks for joining us today. And Nick, we've been hearing a lot of people talk about taxes lately, right? Taxes have been in the news. It tends to come up every election cycle, and we're kind of heading in that direction. And so let's talk about why retirees in particular have to be concerned about taxes in the future, right? So let's start here. Let's start with the basics, which is, do we think taxes in the next 10 years in this country, are they going to go up or are they going to go down? What's your thought on that?
Well, I know that when we do our regular seminars, right, where we're educating people about retirement and taxes and everything, you tend to ask that question, and I don't think a lot of hands go up saying that they think it's going to go down. Right? So taxes are going to go up. I can't say they're not, but I think they're going to go up, right? There's no doubt. With all the spending that we've had over the last several years related to COVID or whatever it might be, taxes are going to have to go up,
I mean, $31.5 trillion, as of this recording, $31.5 trillion in national debt, and the Fed is increasing interest rates. I read an article the other day on the internet that said the Fed increasing interest rates could actually add another $2.3 trillion to the deficit just through interest, right? So is that a huge concern?
Absolutely.
I think it has to be. I mean, we can't just keep running up the debt and having it be unaccounted for. And so what does that mean? It means that someone's got to pay for it. Well, guess what? They're already taxing the people that are working. The next logical subset of people that I think they're going to tax are the people that have money in retirement accounts, right? So you have a 401k, you have an IRA, 403b, TSP that you've been contributing to for the last 30 or 40 years before you get to retirement, and now you have to pay taxes on every single last penny of that when you pull the money out. That's a huge issue, right?
I think most people think they're going to be in a lower bracket in retirement, but when you throw all those other things in, and being that pensions are not as prevalent as they used to be. In our area where we are in Maryland, D.C., we get a lot of government pensions, a lot of teachers, a lot of state pensions, but there's still a gap for some people.
You were telling me the other day that you met with a client who's been a long-standing client, but she was working and then she retired, and her tax bracket actually went up in retirement. Is that true?
Yeah, I mean, that's true. And one of the big impacts of that is required minimum distributions. Now, those don't take effect until 72 at this point. But that's an unexpected increase to people's income and potentially tax bracket when they're in retirement.
So let's drill down on that because, RMD, required minimum distribution, a lot of people out there might not actually know what that is. So let's take a minute and talk about that. So required minimum distribution is this idea that you've been saving money into these pre-tax retirement accounts for all these years, and then at some point in time, the IRS or the federal government will force you to take money out of your retirement accounts, right? So when does that happen and why is it important?
So it happens every year starting at the age of 72. Okay. So it used to be 70 and a half. There was a law that went into effect at the end of 2019 that changed the age. And it's something that Prashant, you and I and Ozzy, when we're talking to our clients and they're reaching that age, we've got this big spreadsheet of people we track every year that have to meet that obligation. And the biggest complaint or comment I get is, wait a minute, I've got to take money out of my IRA that I don't need and pay taxes on it.
So that counts as income.
Absolutely.
In the year that you withdraw it. So you don't need the income. They're forcing you to take it. It counts as income, which means that it increases your adjusted gross income, which could increase your tax bracket. There's another thing with Medicare too that I think a lot of people don't know about. The interesting thing is I think a lot of advisors don't realize this. Talk about how required minimum distributions can impact your Medicare premiums.
So your Medicare premiums, again, are based upon how much money you make, even in retirement. Even though you're not going to work every day, you still have an income that has a certain tax bracket. And once you go over a certain threshold, your Medicare premiums go up. And the biggest culprit to this increase for a lot of our clients is when they reach RMD age, required minimum distribution age.
And I was actually looking at the Medicare tables, and it's really interesting. If the first table, like standard original Medicare, Part B now is $170.10 for 2022. If you go into that next bracket, it goes up, and there's probably 4 or 5 different brackets. It goes from 170, then up to 238, then it goes up to 280 or 340 or whatever it is. But I always thought the interesting thing is they're only basing that on my income. So if my income goes up unnecessarily, I'm not only paying more in taxes, I'm increasing my tax bracket potentially, and now my Medicare premium has now doubled or maybe even tripled depending on how big my income has gotten, right? Now, the funny thing I've always thought is just because I'm paying more for Medicare, does that mean I get better insurance?
No, that's not the case.
It's not the case, right? And so I get this question a lot is, what is the difference between a tax preparer and a tax advisor, and how does that even play into our retirement plan?
Right. So a tax preparer, there's certain license, so to speak, that you can get that will allow you to prepare taxes. We've actually have a number of clients that prepare tax returns for friends or family or whatever, and they're not tax professionals, they're not planners, they're not advisors. So what we look at as planning or advising for taxes is looking forward and finding out, are there ways that we can reduce the tax impact of the money that you have coming in?
Yep. So yeah, it's funny. I always like to say when we drive our car, do we look out the rear view or do we like to look forward when we're driving? Most people say, I like to look forward, right? So that's exactly the difference between a tax preparer and a tax advisor. Tax preparer is looking backwards to just figure out what we did for the previous year. A tax advisor, in conjunction with a fiduciary like you and like myself, we're really trying to optimize our tax strategy moving forward because we know that taxes are likely going to go up. And so here's kind of an idea. If taxes are relatively low today, doesn't it make sense to maybe take advantage of lower taxes today if we think that they're going to be higher in the future?
And we can tease a little bit of a segment we might do down the line. Roth IRAs are a perfect tax planning solution.
So give me the 15-second kind of overview of what a Roth IRA is.
So a Roth IRA is money that you put in after you've paid the tax.
Okay.
And the money grows tax deferred.
Yep.
And when you take the money out at some point in the future, 5 years or later, it is tax-free, 100% tax-free at that point in time.
So that sounds pretty sweet, first of all. Anytime I hear tax-free, I'm a big fan. What we're gonna do is, if you are concerned about your tax liability in the future, just pick up the phone and give us a call. We'll have a complimentary conversation with you. It's 443-274-3002 to learn more about your taxes. But stay tuned and check out our YouTube for another video on Roth IRA conversions and why they're so important. Thanks for joining us today.